Hey Shane, how's it going?
I'm good, man. I got my bear costume on today. So feeling good, doing all right. How about you?
I should probably have a bear costume on as well. It's big news yesterday with the Fed. Markets are certainly reacting off that, and we'll talk about that. But yeah, a lot of fun out there. But I think I'm with you. I'm a bear.
Looking ugly, man. They're gonna try and put a little bounce together, it looks like, while we're on the call here. But yeah, the S&P 500 still down 0.5% for the day. Was down, geez, was down a bit more. Was down about 1.5% earlier today. So up off the lows, but still down for the day after nice down day yesterday. So yeah, things are looking pretty gnarly. Um, the bears, the people who are short, need to cover those shorts as the trade goes their way. So what you see is a lot of buying and crappy companies out there today, which is indicative of big funds covering their short positions. It's not really indicative of new money being put to work on the long side. So be careful out there. But yeah, let's just jump into it.
Sounds
Because
good. And
the next slide we got for the attorneys, they made us do it. So you might as well go to that next slide for a second for everybody to know that this is for education purposes only, and then we can move on to the next.
perfect. Well, the first one here is so we highlighted in the September 1st market chat just some of the goals of the Fed, and we have some comments that were made on that. So go ahead and flip to that so we can
Yeah,
read
this
through that.
was this was the slide from nine. Like we put this together, and we had the little arrow that said not bullish. The comments were on August 26th. They were very short, concise, and terse, and bearish, decidedly bearish or hawkish. They love animal analogies, but all the bad animals of the zoo are out on this one, and everybody knew it. There's 14 points in here. Not a single one of them are bullish. And I probably could have put together more points than just this one, than just these 14. I was just, trying to hit the high points. So, um, yeah, it was not bullish. It was definitely hawkish, and we haven't really heard the Fed change their tone since then. Yet, if you want to go to the next slide, we get people from, the biggest money management firms in the world. This one's from Morgan Stanley. This was on Monday of this week, literally Monday, 4 days ago, 3 days before, or really 2 days before the Fed was going to announce their interest rate decision. You get Morgan Stanley, the guy Mike Wilson saying that you see the word pivot in there. Uh, Looks like Kyle already put up the next article, but Fed will pivot from interest rate hikes. And that's going to make the stocks rally 6%. And then you got JP Morgan again on October 31st, which is Monday. Um, Kyle, you want to tap the button?
Yep.
There you go. October 31st, again, Monday, saying dovish Fed could spark a 10% S&P 500 rally. We just got through telling you that back in August, when we discussed it on the September 1st Elevate chat, there's nothing dovish going on at the Fed. I don't know where these guys are getting this from. It seems like it seems like a pump, right? Like a fraudulent pump where they're trying to beg the Fed to cut interest rates so that their stock portfolios can recover. Because these guys don't hold cash. They're just long all year. They're getting killed. Their clients are getting killed. The clients are calling in asking how their stocks are doing. Should they stay the course? And these guys are like, "Oh, you should buy more." They've been saying it all year. You should put more money in. It's always a good time to buy. These guys are awful. And if you have your money managed by Morgan Stanley or JP Morgan or any other firms like those, you should give us a call and we can talk to you about a little bit different way to manage portfolios. Because if you go to the next slide, what you'll see is that good old Mr. Powell blew these guys out of the water. So on when these guys wrote those hard headlines and said those things on Monday, and on Wednesday, yesterday, Powell says, as we make these ongoing rate hikes. So nowhere in there does it say he's going to pivot It doesn't even say he's going to pause hiking rates. They're just going to keep hiking. That's what they're going to do. And anybody who thinks otherwise is they're just mistaken. They're not paying attention because this has been pretty clear. Powell went on to say, it's very premature to be thinking about pausing. So not only are they not pivoting, but they're not pausing, and they're not even thinking about pausing yet. So they will raise rates again in December. The only question is by how much. And beyond that, they'll probably continue to raise. So we'll get to a slide later that shows you when we think they might be done. We've been over it a couple of times, and we'll stay on that in these chats. But Powell wasn't even done there. He went on further, and this is all in one answer to the same question. This is just one answer to one question, and he just hammered them. We have a ways to go. We need ongoing rate hikes. And you feel free to pause the video and read the rest of the comments. You can actually go get the whole transcript in probably a whole bunch of different places. This one came from the Wall Street Journal. But look, anybody who is telling you that the Fed is going to pivot and they're going to start cutting rates or they're going to stop is not paying attention. Eventually, sure, that's going to happen. There's no doubt about it, but it's not anytime soon. Unless you're talking about months as soon relative to years, sure, fine. But these guys writing this stuff on Monday of this week were assuming that the Fed was going to say something dovish in their release on Wednesday, and they did add one little comment to their statement, but there was nothing bullish about it. It was totally misinterpreted by the market for about the first 20 minutes, maybe 30 minutes after the release, and then the market took a nice big dump to some fresh lows for the week. So it's yeah, I don't know. It's shocking to me how many people fell for this pivot narrative. It's happened a couple of times now. I mean, I don't know where they get it from, but these guys are crazy. There's no pivot happening.
And it's interesting because the Fed, one of the worst things that could happen is if inflation, they get it down, but not all the way, and then it just runs right back up. Now you're just really trying to play catch up, and that'd be a pretty bad scenario. So
Yeah, which
yeah,
if you go
there's
back to that 9-1 slide, you don't have to. I'm just saying if somebody rewinds the video and goes back and looks at it, that's one of the things Powell said in that speech. That's one of the points. He was like, look, the risk of he said it again in the questions this week, but they know that the risk of not getting the job done leads to a decade of stagflation. So he's like, look, I'd rather tighten too much and then use our tools to fix that problem, which is terrifying because their tools are to print money and drop rates and all that kind of thing. But he'd rather go too far than not far enough. And it's just been very clear the entire time that that's his deal. So I think he nailed that one, Kyle.
Yep.
So pivot
So
narrative got demolished there.
yeah, key takeaway there. So then we go back to, just big picture on the SPY. We don't need to spend too much time on this one, but we have a lower high. And if we zoom in, this was running up to the meeting. And then yesterday we tried to rally a little bit when they started talking and then kind of fell off a cliff a little bit.
Not a little bit, a lot of it. I'd say a lot of it. All the people who were getting all bulled up. We're gonna run. We're over the 50. We're gonna run to the 200-day moving average. Yeah, don't let those guys manage your money. It's just ridiculous. They're down. They're losing money, and they're stuck to their narrative. And the narrative doesn't mean anything. It's all about the math. So we can leave our narratives at the door. We just need to look at what's going on, look at reality, and forget about the stories. Salesmen tell stories, right? Portfolio managers analyze. And so that's what we do. And just nothing to be bullish about. There's no reason to try and pick the bottom. There's no reason to feel FOMO. We're professionals, and we'll have eternity to buy this stock market on dips when it finally turns into a bull market. But we're not there yet. We're just not there yet.
And then same thing with the Qs and zoomed out version, but
yeah, which shows you. Hold on, go back though. I mean, this is the point of this slide is to show you where the stock market closed in 2020. So we have the 2020 close line on there, 313.74. So you can see how much the market went up in 2021, and you can now see that we've given back all of those gains and then some. That's the point of the zoomed out view, is just to kind of give you the lay of the land and the bigger picture. But the next slide gives you a little bit better visual on what's currently going on. So yeah, I mean, you can still see that 2020 close. You can see we're well below it, even the 50-day moving average, and now the 200-day moving average is below where the QQQ closed in 2020. So this thing is just in a painful, really brutal bear market, down, more than 30% from its highs in November of last year, and doesn't look like it's going to go up anytime soon. Kind of a perfect tag of the 50-day moving average too, and rejection. So you can see MACD at the very bottom is getting ready to roll over and turn red. Even if we get a little rally today to kind of close that gap, I'd be looking to sell.
Yeah.
Just sell rips. You don't buy dips in bear markets, you sell rips. That's the deal.
No. And now too, we're heading into year end where, yesterday I think I messaged you is no Santa Claus rally this year. I think this is usually where it sets up and you get that nice rally into the year end historically. And I'm looking, I'd be curious what the actual stats are, but going down into the, start of November doesn't make me feel very good about going into year end.
Yeah, as far as seasonality goes, and we looked at this a couple of weeks ago, but middle of October, like October 14th is usually the beginning of the Santa Claus rally. And that's not likely to happen this year. You know what else is interesting? And I don't really have any slides, or wasn't really thinking about this when we were preparing for the call, but we're into that part of the year now where the losers, the things that are down the most, just tend to go down more due to tax loss selling. So, if you're in a taxable account and you're down $10,000 on a position because it's sucked all year long, odds are you're going to sell that position for at least 30 days to realize the tax loss. And if you want to buy the position back, maybe you will before the end of the year. But everybody has a little bit different methodology on that. Like, do you want to do it in November so that you can buy it back in December before the year's over? Or do you just wait until the end of the year and see if the loss gets bigger and realize the max loss? There's, you can see like this year, the turn of the calendar was a major change, right? The moment we got into 2022, the market never made another high. So sometimes the calendar change into a new year can do stuff like that. We at Elevate tend to do our tax loss selling in November, so that if we want to buy the stock back, because we like the stock overall, it's just down for the year, so we want to realize the tax loss. Usually we do that in November so that we have the opportunity to buy it back before the year is over, and maybe front run any type of like January rallies. So this is that part of the year. Like hedge funds will be doing it. Big funds will be looking for losses, and they'll be looking to salvage anything they can. So if they have a nice big loss in a position, that's down already a lot for the year, it will lose more because there's going to be a lot of people who are down that sell it for tax reasons. So here's the other side, is the things that are doing well this year, the stocks that are up. And by the way, there are some. We had 4 stocks that we follow hit all-time highs last week on Friday. They were McDonald's, Hershey, W.R. Berkley Insurance, and United Health Group. Those companies that are doing well are likely to continue doing well because nobody wants to sell them and realize a taxable gain before the end of the year. They want to let that thing roll over to the following calendar year. And so, if you have to sell something and you're a hedge fund, what are you going to sell? Something that's up a lot or something that's down a lot? You're probably going to sell the thing that's down a lot, and you're not going to want to touch the gains. So
Right.
nothing worse than handing your clients a tax bill in a year where they lost money. That's not a good thing to do for career security. So anyway, we don't have a slide for that, but that's just how it works at this part of the year. So look out for the losers to lose more.
Yep. And then this one, so Apple, this is a big name. Most people have this in their portfolio. Shane, you highlighted this gap, and a lot of times you might fill that gap, so it could come back up there, but certainly created one there, and it's a pretty meaningful one.
Yeah, I assume it'll get filled at some point. Whether it gets filled, in the near term before it drops lower or something like that, who knows? But again, the MACD at the bottom suggests that this thing's going to go lower. If it breaks through 138 on the downside, it's easily going to go to 129. If it drops below 129, it could easily go to 100. There's no, like, Apple is not bulletproof. Just wait till we get to some Google and Amazon and Microsoft and Facebook charts, like Apple's not immune to that happening. It's just kind of the last standing general, right? That needs to get taken out back and shot. And so when people finally start selling Apple, maybe for tax loss reasons this year, because it is down, when it finally gets accelerating to the downside, people will just sell indiscriminately, and this thing could drop just as hard, if not harder, than any of the other stocks. So remember, Enron was actually the most loved company in the stock market when it failed and went to zero. So there's a lot of things that are possible. And I'm not calling Apple Enron. Don't, you know, don't, I'm not suggesting that they're a fraud or anything like that. But when things get going, man, they get going fast. So Apple can easily drop much lower.
Yep. And it's one of those things, Apple's a great company, but it's just the market mechanics when you own stocks is they can go up to really high numbers and they can also go down to low numbers. So,
Yeah. I mean,
you
hey,
know,
Cisco's a great company. It's been a great company for 20 years, but it's still never gotten back to its 2000 peak.
hmm
Still, I mean, we're 22 years later and it still hasn't gotten there. Don't have a chart for that either. Sorry, you have to go look it up on your own.
Yep. And then here's, Tesla, which was just the darling of the COVID rally. And we're sitting here back at the bottom of this channel. I'm really curious, this level right here, that's pretty meaningful when I'm looking at this chart. We break that and you could probably see a move down to here at the kind of 180 level.
Yep. MACD
And
looks like it's ready to roll over, go negative. We got a little short-term top in. I wouldn't want to own Tesla here. If I did, I'd have my stop at that recent low. You know, maybe it's right around 200 bucks and a little bit of risk, but I wouldn't want to own it at all. It just looks awful.
hmm yeah, we like charts that are trending up and they're simple. And here's one, Amazon. I can't tell you how many times I order stuff off Amazon. So again, great company, but we put a gap in there and it's like nothing can save it right now.
Yeah,
What are
it,
you
it never
seeing?
ceases to amaze me that people, that Peter Lynch guy wrote the book on buying what you know or whatever, right? I think that was Peter Lynch, right? Do you
It
remember?
was.
Yeah.
Yep.
So that might have worked in like 1980. It doesn't work now. Everybody knows that trick, and I don't, just because you buy a lot of stuff on Amazon doesn't mean anything. These guys are in big trouble. They're discretionary stock heading into a slowing economy with a tightening Fed. Um, their earnings are not very good lately. There's really not much prospect of that getting better. They've frozen hiring. They've hired less people for the holidays than they ever have, or they have in recent history anyway. The trend is awful. There's no reason that you would want to buy this here. Will Amazon be higher a year from now? Probably. 2 years from now? Almost certainly. As long as it doesn't fail.
Yeah.
But there's no reason it can't go to 80 or 75 before it goes higher because the trend is awful. And there's no good reason to buy this. There's no fundamental reason to buy it. It's not terribly expensive and it's down a lot, but that's not a good reason to buy a stock. That's actually a better reason to short a stock. So if you're looking at buying Amazon, I had a client do this today. He asked me to put in a buy order at 80 bucks, which I think is a good idea. If you have a long-term holding period, and you want to forget that you own this stock for the next several quarters, you could buy it at 89.50, but I bet you'll be able to buy it at 80 sometime, in the next couple of months if the Fed continues to tighten and the economy continues to grind to a halt. All it takes is a bad holiday season and Amazon's going way lower, like way
Yeah.
way lower than 80 even. So
Yeah.
be careful out there, but this thing looks awful.
Yep. And Shane, I thought I would just add, so Peter Lynch, he had that book, One Up on Wall Street. So that's where he was talking about buying what you know. But
Okay,
the key point there was that he's talking about in your local town, you're going to get exposed to new trends that have not caught on yet.
right.
As you know, Amazon is it's a Goliath company. Everybody's seen it. So you're a little late in the game to get in on what you know,
Yeah.
versus
You're
if it was some new store that's got 5 locations and growing fast, something like
Yeah,
that.
you're not front running the market on your Amazon buy. I promise.
Yep.
No secrets there.
And so Google, same. I use a search engine all the time. I'm familiar with it, but as a company right now, I see this chart and man, it's just kind of falling down. Same thing, MACD negative.
Yeah. I mean, we're gonna post this on YouTube, right? but
Yep.
all the advertising is slowing down. People are not paying as much to advertise. I don't know if there are advertisements on this video or how Google chooses that, but um, people who buy ads aren't buying as many ads as they used to. They're not hiring as many people as they used to. They're laying people off. Um, Google's has frozen hiring as well, if I remember right. I can't remember all the headlines anyway. I can't keep them straight. Microsoft laid off 1,000 people, which is only like 1% of their workforce. But yeah, this thing again, there's just no support. It's broken down. There's no reason to pick the bottom here. If you wait until it actually develops an uptrend, a series of higher lows and higher highs, and breaks through some of these trend lines, you will make a ton of money. You do not need to pick the bottom to make a ton of money here. And Google's another one where based on fundamentals, it looks pretty cheap, but those fundamentals include earnings that may not be carried forward into the future. Like there's no guarantee that whatever Google was making last year, that they're going to continue to earn. And as that E comes down, right, the E for earnings comes down, it begins to look more and more expensive, even as the stock price goes lower. So, um, looking in the rearview mirror to determine future fundamentals is not a very good idea, especially in a bear market and a slowing economy with the Fed hiking rates. Like this is a bad time to be trying to pick stocks, even the ones that people think are the biggest and the baddest, the mega cap techs that are never going to go away. Doesn't mean they can't drop by 50% from where they are today. I know that sounds crazy. I know it sounds totally crazy, but just wait till we get to the Facebook chart.
Yeah. And Microsoft again. So you can see there's something consistent in a lot of these charts. Gap down, it's already in a downtrend, and it tends to accelerate off that from what we're seeing. And MACD's rolling negative.
Yeah.
I don't know if there's any difference here. Again, Microsoft, great company.
Yep.
Not a great chart right now.
No, it's terrible. I mean, we're using Microsoft every day. Everybody's using it every day. Office is a big deal, Azure and uh, Teams, and they own Xbox and they're buying Activision Blizzard. I mean, they got a ton of things going on, all going the right way. Stock not going the right way. And so you see this gap down and a break to fresh lows after it's already down 20, 30% from highs.
Mm-hmm.
You look at this thing in June and you're like, wow, Microsoft's cheap. And then you fast forward to today, well, what used to cost you $250 now costs you $210 or 217, so now it's cheaper. And that's the thing that happens. I learned it from the guys at Hedge Eye. It's a great little saying is that markets crash from oversold levels. So once it's already oversold, you think, wow, it's oversold. I'm going to buy it. It's going to go up. Sure, sometimes it does, and sometimes it goes up for a little while only to crash to a fresh low. And that's because the economic environment we're in is not conducive to buying growth tech stocks. It's not going to be for a while.
Yep. And that's kind of most stocks, but there are still good ones. And so here is Meta,
Whew.
perfect example of a darling that was doing so great, just up 900%, and then all the way back down here, still up 156%, but not really all that impressive when you consider the risk that you take, and getting in. I assume, is that back at the IPO,
Yeah,
Shane?
that was the IPO price back in, I guess, 2012. Must have been no, that was 2013. So year end 2013 is right after that. That's where you see the 2013 is the year ending 2013, it looks like. So, is that right? No, I'm wrong. So 2012. But anyway, yeah, if you had bought it at the IPO and held it through all of its drawdowns, and you can see it went down a lot at the beginning, like from its IPO, it took a couple years to get back above its IPO price. So I mean, you would have had to hold through all that, and major drawdowns and downs in 2018 and major drawdowns during COVID, and you could have been up 900%. But I mean, it's dropped 74% literally in a year. I mean, that's in 1 year. And people will look at me and tell me, Amazon's down 30%. It's like it can't go lower. Why not? Like why not? Once everybody who wants to buy has bought, the only people left are sellers, and
Mm-hmm.
it'll drop. Same thing with Google. So, um, yeah, this is just a disaster of a company. Now they're spending a ton of money. that they don't, thankfully they earn a lot of money, so they have some to spend, but it just seems like they're putting all of their investments into the wrong things. Maybe the metaverse deal will all pan out and pay off, and you know, 10 years from now, we'll be talking about how it was, if buying and holding from the IPO is the greatest thing of all time because it's up 10,000%. It's certainly possible. I think it's unlikely. I think it'll take a decade to get back to 380, you know,
And that's
where it is.
assuming we don't hit zero first.
Yeah.
You never know.
Once you're down 80%, you got to have a 400% rate of return to get back to even, right? So we're pushing 80% down because it's down more. I built this chart I think last week and posted it on LinkedIn. So this is a little outdated, and I think it's dropped a little bit more since then. And so, I mean, it's down 80%. It needs to go up 400% to get back to even. Do you think so? If you got 400%, if you thought Meta was going to get back to its all-time high, do you really need to pick the bottom? I mean, how many hundreds of percent do you really need to make to call it a good investment or a good trade? You don't
Hmm.
need to pick the bottom. There's no need. Why not just wait until it starts developing an uptrend again, which it will someday, in all likelihood. Just wait for that and then buy it. There's no
Yeah.
reason to try and catch this falling knife because it might not be done falling.
And you can, if your entry's here, excuse me, you could still lose 74% from here.
Oh,
You
dude,
know,
you could lose. Yeah, you could
you
lose
lose
100%.
100%.
Yeah, sure.
So,
Wouldn't want to touch it. No way. Not on the line.
yeah.
And it looks cheap too. That's the other thing, is it looks super cheap. Valuation looks so cheap, but I don't think the earnings are going to come down for decades,
Yep.
when it's a lot of old people using Facebook these days. Granted, I know
And
they own Meta and Instagram, or they own Instagram and WhatsApp and other stuff, but their core business is dying.
yeah. And then here's just that 60/40 portfolio we always hit on. And the key thing here is that somehow historical correlations, they looked at it and said 60/40, that's a great way to go. It's always going to work. But when you have bonds that are so overbought, you can have a scenario here where they go down. And as the Fed keeps hiking rates, we have inflation. I wouldn't be surprised whatsoever. Just keep seeing this relationship work its way down.
Yeah, it looks ugly. If you're in a 60/40 pie chart at Edward Jones or at some other institution that doesn't actively manage portfolios and tells you about time in the market versus timing the market and stay diversified and focus on the long term, I promise you they're doing you a giant disservice, and you should give us a call.
Yep. So turn into oil. This is one we've been really bullish on it. And we had this rally up. Our last call, we were talking about kind of this level. Once it broke out of that $90 level, it could really go. And we're just we're stuck there right now. We haven't really done a whole lot yet. So could happen here. I'm still, I feel constructive on it. What do you got, Shane?
Not much. I mean, consolidating below a major level, you see that orange line with all those red circles. That's a major level there. So until we
Hmm.
break way above that, with some volume and some velocity, I think it's just in a consolidating pattern. Above the 50-day, below the 200-day. It's hard to get too excited about it, but I don't think it's likely to crash. Oh wow, and that's on a percent. I wonder why I got that on a percent. Axis. We don't have the price there. That's kind of unfortunate.
Yeah, it's interesting. And I know oil, just for, viewers, $90, that's right here. So at the high, I think today we're trading down right around 88. So we've been moving sideways a little bit in this small area, but we'll see. Once it goes, it could has some room to run.
Dang, that happened on all of the rest of our charts too. Bummer.
Oh.
Well, that's not cool.
Well, hopefully we'll know the price here, but
Yeah.
Shane, you brought this chart up, and this is, to be clear, this is oil. However, it's priced in yen. So the chart we just showed you is priced in US dollars. And what this is showing, Japan doesn't, they don't have oil in their country. They're an importer. And what you're seeing here is that oil is the most expensive it's been since, 2007. So right here, priced in their currency. So in other words, energy is really expensive for them.
Yeah. Yeah. Pretty brutal. Pretty brutal.
And then I think this is our favorite chart each time is, XLE. Just we had that awesome breakout. and it's tracking higher. It's probably gonna take a little breather, but up 30% in 23 days. It's pretty good.
Yeah, I'd say. I'd say. Yeah, I'm really bummed out about these prices. I'm thinking about maybe having it switch to maybe I'll just take over the charts here for now because we got a few more charts to go through. How about that? Let's do that. Let me share my screen if that's all right with you, Kyle.
Sounds good. Yep,
All
I'll
right,
flip
cool.
it over so it's on you.
Here it is.
There you go.
Y'all can see my screen? Cool.
We
Yeah,
can.
so $90.69 is where we're trading at currently on the XLE. And if you let's see, from here, just to here, where it's up 38% from the lows on July 11th, which is crazy. And we're up, call it 32% again from the lows on September 26th. So yeah, this XLE just needs the price of oil to not crash, and it will continue higher. So that's great. Next on the list is what? Bitcoin?
Yep. So our next one is Bitcoin.
Yeah, okay. Let me get that here. There you go. Yeah, so Bitcoin got the percentages in there again. How do I get this to regular? What's going on here? Oh, that's not percentages. Okay, cool. Yeah, we're good. Yeah, so holding the 17,500 level still. Oh, this is on weekly. I was like, what? Something doesn't look right. There we go. That's a little better. Okay. Sorry for that, everybody. I think we're back on track here now. But obviously, Bitcoin's been in a major downtrend. Down what? 70% was down closer to 80% here at the lows. 74%, just like Facebook, it looks like. And since back in June, it's been kind of just consolidating and staying above the 17,500 level. And so I bought a little bit of Bitcoin not too long ago, and as long as it stays above the 50-day moving average and above this purple trend line, I think I'll stick with it for a little bit. And I do know that the momentum is kind of looking like it wants to roll over to the negative side. So we'll see what happens, but I'm going to keep my stop at like 17,500 for the small position that I own. And if it continues to go higher, I'll just keep adding to it. So right now I'd be waiting for a breakout of the recent highs around 21,000, and certainly a breakout above this 22,000 level would be pretty bullish for me. But even then, you have the 200-day moving average right above, but that's a 10% move. So, Bitcoin's pretty volatile. So anyway, I'm constructive on it for the first time in a long time, and I'm not betting the farm, that's for sure.
Yeah. And then Shane, I think we have the 10-year next if you want to pull that up.
10-year yield. There it is.
So once again, just gorgeous chart on this one, but not in terms of what it implies for the economy or the market. So yields just keep pushing higher. It's getting really expensive. If you want to buy a house or buy capital goods where you want to finance those, you're paying a lot in interest.
Yeah, brutal. That's a clean chart right there. It tried to break below, we highlighted this last week, and I think I said I would not be surprised by the time we had this call today if it was right back above 4.4. And we didn't quite get there, but we did get to over 4.2 this morning on the heels of the Fed's latest rate hike. You can also see down here that we are showing a trend higher, right? So it's negative momentum, but getting more constructive. And so I think, if the Fed keeps raising rates, this thing's going to go higher. We're going to eventually break through this 4.4 level, and who knows how high we'll go after that. But just another higher low in yields. So I think it could easily get more expensive to conduct business.
Yep. And then next is 10s minus 2s, if you want to pull that up.
Yeah, no need to spend a bunch of time here. This one just shows that we broke it now. Wow. Yeah, we're at minus, well, looks like it's at minus 51. So we're at the lows for this cycle. So this is not improving. This is getting worse. an inverted yield curve is bad for the economy, and we are pretty heavily inverted and worsening, which means the 2-year rate has gone up faster than the 10-year rate over the past couple of days. So, be mindful of that. That's not good for the economy overall.
No. And this is one of those things that is probably one of the best predictors of a recession.
Yep.
And it's just not good for business in any fashion. So,
Yeah, I mean,
and
even this little inversion right here front ran this recession, right?
yep,
Back here we had this whole period of inversion, and then a recession happened, a few months. This was probably like 18 months later. So, same idea. Every time that happens, there's a recession that follows. It's pretty obvious. So, no telling when the next recession will officially start, but I think we're already in it.
yep, I agree. So, and Shane, it looks like my charts, the dollar's next, and looks like that one's queued up correct. So
Oh, cool.
why
I'll
don't
give it
I,
back to you then. Yeah,
yep, I'll take it back over.
great. I'll take a sip of coffee while we wait for your screen.
All right, so we got it back up here. So, the US dollar, this is one thing, it is not helping the stock market. So the stronger the dollar gets, this is one thing I've been watching. So when I'm trying to get an idea every day, how scary is a sell-off? What's it really looking like? I'm looking at the US dollar and then treasuries. If treasuries rates are going up and you've got this dollar that keeps going up, those are two headwinds that do not help the stock market. And I mean, this looks like one just massive wedge forming and
Hmm.
going to continue higher. So it's going to be interesting to see what the fallout from that is, but that's, yeah, certainly not a positive.
Now, the longer this thing goes sideways, the more likely it is that it will break severely to the upside, probably around the beginning of the year next year. And,
Yep.
there was some questions to Powell yesterday about the dollar and exporting those issues around the globe, basically, and how the strong dollar is really hurting a whole bunch of foreign countries. And Powell said, so we know that we need to use our tools to get inflation under control. The world is not going to be better off if we fail to do that. So he doesn't. He had his Republican hat on. Jerome Powell is a Republican. He had his Republican hat on yesterday, and so he doesn't care about the rest of the world and their problems. He says, "Look, it's going to be better in the long run for everybody to have a strong dollar, which is the primary um, reserve currency in the around the world." And so he says the world is not going to be better off if we fail to get price stability under control. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run, which is the American people. So he
Yep.
said, don't care about other countries. It's not influencing our decision at all. So no matter how bad things get for other countries, the Fed seems to be not listening.
That's true. So, and then here's one, we pointed this out, but Dr. Copper. So copper traditionally is a great predictor of a recession, goes into a lot of industrial production. Um, looks like it's formed that wedge. We had a little breakout. It could move down here, but this is probably going to take some time to resolve. So, we'll touch on it each week, but I'm guessing it's going to take a little time and then
Yeah, I don't
finally
even
it will
know.
break.
Oh, sorry, I thought you were done. I don't even know
Yep.
about each week. I thought this was such a clean, pretty little chart that it would break, lower.
Hmm.
Because usually on a wedge like this, it'll break the same direction as it came into the wedge, right? So it's
Yep.
a flag, if you want to call it that. Usually the flag pull is the other way around, though. So anyway, 9 times out of 10, this is breaking to the downside, and so we got that little fake out breakout to the upside a few days ago. And it looks to me like that's going to turn into a fake out. Usually, when you see that and see it fail and see it continue to consolidate, it's going to roll over and break the other way. So I think that we're just a little bit closer to copper breaking down hard. I know a lot of people who are short in copper miners right now. COPX is a symbol you can look at for that. Um, and I know couple of the companies, Freeport McMoran, FCX reported recently and has actually screamed higher, so it probably helps out some things. But copper to me looks like it's gonna fake out and break down from here. So something I'll just keep my eye on because it's so pretty.
Yeah.
And hopefully it doesn't drop all the way down to the COVID lows, for the economy's sake. But kind of looks like there's not a lot stopping that from happening if it breaks down from here. So
Yep. And then this is the next one where, man, you want to buy a house right now, you're going to be borrowing, paying a lot. So I think on this one, you know, we had this high here, that 6.6. Shane, you had highlighted that. So that was '07.
yep.
And we are over that. I don't
Yep.
take that as a positive sign. And you better believe the housing market will need to correct to adjust for it because people don't want to borrow a ton of money to buy an expensive house that, they're paying
Yeah.
the bank 7% on.
Yep. Down a bit from last week. Last week we were over 7, so maybe maybe we'll get a little bit of a pullback. So if you're looking to acquire a new mortgage for a new home you're buying, keep a close eye. You might get a bit of a reprieve here in the next couple of weeks. But I'm not sure that we're going to go materially lower. It might just kind of be sideways to down a little bit. So if you're looking to lock in the best rate in the short term, pay attention.
Yep. And here's our chart we always hit on. And we've seen this again. So I don't know the stat this last rally. Did we hit? I know we got over 10% and it is a smaller rally, but man, don't be surprised by these as we go through bear market. This is '08. You're going to see some serious rallies that make you really question if, is this the bottom? Did I miss out? And don't be surprised by that.
Don't get got by FOMO. It's just ridiculous. I mean, I don't even know if this most recent rally can qualify as a bear market rally. We got to a peak of 11.56%, which took the Qs, for example, from being down 37% to at the peak of this rally being down 30%. So I don't even know if that qualifies as a bear market rally. I mean, when you're down 37%, you got to rally by, at least 15, to call it a real good rally. I got to tell you, like, it's hard to stay short and hard to stay bearish when the market's up 20%. This most recent bounce to me was not hard. I was just like, this is the dumbest thing I've ever seen. And, I'm not trying to pat myself on the back. It's just like, every day I do this, I've done it for a day longer than I did the day before. And when I stop learning, I hope I get fired from this job, because if I can't get better, I'm gonna go find something else to do. So, I think that's what we all need to do every day. We just need to get a little bit better, get a little bit better, get a little bit better. And, a year from now, we'll look back and say, man, we got a lot better over that term. And so I know I can get better. And, we didn't buy a stock for 3 full months in our growth strategy, and I very reluctantly bought one growth stock during that most recent bounce, and we took a very small position size in it, and we'll look to add to it as long as we don't stop out of it. But I mean, there was just no good fundamental reason to buy stocks for the last couple of weeks while everybody in the market was begging the Fed for a pivot that wasn't even going to come. And if you're paying attention, if you're reading what the Fed says and looking at the economics, they're not going to pivot. They're not going to pivot. A pivot means from hiking rates to cutting rates. They're not even talking about pausing rate hikes, let alone pivoting. It's just not going to happen. So that most recent rally was just I don't know. I have a hard time calling it fraudulent because it actually happened. You can see it on the chart, but the reasons for it and the people who were instigating it, the Morgan Stanleys and the JP Morgans and the lead economists that get the most airtime on CNBC, the Cartoon Network, that's who was perpetuating this kind of false narrative. And so when you hear that kind of crap, you gotta know, you gotta know that you're hearing crap, and you got to take advantage to short these rallies in a bear market. So that was way more time than I needed to spend on this, but it just kind of bothers me. This most recent rally, got as much legs as it even did, based on hopes,
Yeah. And I think when I looked at it, you'd always have short covering rallies. So people that were short are trying to get out of their positions, lock in profits. But what I thought was interesting was the headlines. So a lot of headlines on this. Oh, they're going to back off. They're going to pivot. And that is not happening. So,
No, not happening.
and here's what we've laid out before. But as you go through and you have your rate increases over here, and then top end of the Fed funds rate, where that puts us, right now, what, April 23, it's kind of the point you might see things level out and the rate hike stop. But Shane, if you want to talk to this one.
Yeah, this just assume that CPI grows 33 basis points month over month, which is 4% year over year, which is what the sticky inflation measures are growing at right now. So I think that'll be stuck with us for a while. And you can see that the rate increases, we had pegged 75 basis points for November, so that did happen. Right now we expect 50 basis point rate hike in December. So slowing the pace of rate hikes is not pivoting to cutting rates. When you're hiking rates, you're hawkish. There's nothing dovish about hiking by less. That's a crazy false narrative you will hear from now until December. Like, oh, they're not going to hike by 75. That means the stocks are going to go up. No, they're not. Rates are going to go up. The discount rates are going to go up. It's going to cost more to borrow money. More people are going to get fired. More people are going to get laid off. Less people are going to get hired. It is not dovish in any way, in any stretch of the imagination, to hike by less. It just means you're less hawkish. It does not mean you are dovish.
Mm-hmm.
So just something very clear that I think people need to understand. Like when you hear that noise, you need to tune it out or go short it.
Yeah. And
So, oh, go ahead.
I was going to say, it's just fascinating yesterday watching that press conference with Powell is that it was really one of those, the Fed wants credibility because if they don't have credibility in fighting inflation, prices will run back up and this whole, oh, we're just going to reverse and we can start buying things and push them right back up again can take over. So it was interesting during that. It was a lot of it felt like the population or the reporters kind of saying, are you really hawkish? Are you really going to do this? And Powell was really stepping up saying, look, like this is no joke. I'm getting this done. Don't question me.
Yeah. Yeah, so this, I mean, on the rate increase side here, you've got 50 basis points in December and then down to 25 basis points in January. So even that is not going to be dovish. That's not going to be a pivot, right? They have to start cutting rates for it to be a pivot. So just that whole narrative needs to be squashed. Anyway, assuming that CPI grows by 33 basis points month over month, and assuming that the Fed hikes in these prescribed or projected amounts and on these dates, that means we'd get to a positive real Fed funds rate, which is the Fed funds rate minus CPI in April of 2023. So that is the most likely time I see the Fed pausing. From now until then, I see them hiking and remaining hawkish, which means that stocks will continue to remain under pressure until at least then. And if if CPI continued to grow at 33 basis points month over month, by August of 2023, you can see that CPI starts going back up from 3.8% up to 4.
Mm-hmm.
And that would lead the Fed to begin hiking again. So there's a lot of ifs in that statement. We have no idea what inflation is going to grow by, and we don't know for sure what the Fed's going to do. But just pointing out the things in this scenario that are interesting is that, if it worked out this way, the Fed would only pause for a few months and then they'd have to resume hiking again to bring inflation back down towards their 2% target. The other alternative is that they would just abandon the 2% target and say, hey, we don't think 2% is reasonable. We're going to target 4% going forward. So anyway, who knows? But that's what we see right now.
Yep. And this one, Shane, you brought up, but CPI food at home. This is a really important one because you can probably talk to this a little more, but food, everybody needs it.
Well, I know that we need to get moving along here, so I won't
Yep.
say much on it, but people tend to say, I'm not eating out when they're, running low on money. What they say is they're going to buy food and make it at home. And so that's not getting any cheaper either. So it's not really saving you that much money to go to the grocery store and cook at home. So that's just tough for a lot of Americans, and I feel their pain. So, yeah, it's just not a good indicator. Inflation is very high and it's becoming entrenched.
Yep. And then Larry
And
Summers.
Yeah, high inflation, it says very clearly, almost never does high inflation come down fast. Today's consensus view that inflation will come way down is outside the range of normal historical experience. So we're probably going to have this inflation for a long time unless the Fed continues. Well, maybe I shouldn't say continues because they're not that aggressive right now, but they need to get aggressive about bringing inflation down, and that's what Powell was saying yesterday. Summers, by the way, went on. He's actually in an article today. I think this is today or yesterday, but he is urging the Fed to continue hiking rates. This is a Democrat, by the way. He's the former U.S. Treasury Secretary, I think under Clinton. But he's a Democrat, and he's still saying, "No, you guys are crazy. You need to hike rates. This is bonkers." So that's I just think that's good evidence that what we need to do is very clear to the Fed and other people who understand economics.
Yep. And then this one, Shane, so GDP and real consumption.
Yeah, so I just want to hit this quick. Thanks for introducing that. We talked about GDP last week, and I talked about how imports were down, and that was really what caused GDP to be positive. I figured without that import number being negative, it probably wouldn't have been positive, but I didn't have any numbers to back it up. I've since come up with some of those numbers through other sources. So the chart you see from Stansberry there says that consumption and investment, which make up 89% of total GDP, slowed sharply in the third quarter. So not just a little bit, but that's what you see in those bars. You see it dropping, and you see it dropping below the 10-year average. So the primary components of GDP are declining. So despite the fact that the government reported a positive GDP last quarter, underlying, it's not very good. And at the very bottom of the chart or of the slide, you'll see that last quarter GDP came in at positive 2.6%. But net exports contributed 2.77% to that figure. So without the net export number being so high, and net exports is exports minus imports. So minus a negative number is a positive number, and that's what caused it to print a positive number. If not for that, we would have been at minus 0.13%. I think is how you do that math. Hard to do in my head, but anyway, that's it.
And then this is one on savings. I've seen a lot on this is, people are not saving very well right now, which with inflation, it makes sense, paying a lot out of pocket, but they also have a lot of debt, which that's a little alarming.
They're running up the credit card bills. So 54% of Americans say they've stopped or reduced retirement savings. 62% worry that a major recession is right around the corner, and 67% say they are nervous about investing but don't want to miss out on the recovery. There's actually one more bullet point in this that I must have left off, but I think it was like 50-some% of people have taken money out of their retirement to cover expenses during this time. I'm looking for the quote now because I'm surprised that I left that out of there. But yeah, furthermore, more than 4 in 10, 43% say they've had to dip into the retirement savings because of rising inflation. That's not a good situation.
No. And then this one, so right here, Russell 1000 stocks, they've been beat up pretty badly. But Shane, if you want to just talk about this.
Yeah, I don't need to beat it to death. I mean, we talk about it all the time. If you drop 80%, you need to make 400% to get back to even. So Coinbase is a pretty close example of that. On this chart here, it's kind of, yeah, you see it there.
Right there.
It's dropped 88% and needs to go up 406% to get back to even. Which is pretty crazy. And so there's just a bunch of stocks just like that. I mean, if you think that these companies are going to go back to their all-time highs, it's a great opportunity to go buy some call options for a few years out. But I'll bet you more of these companies are going to zero than go back to their all-time high. That'd be my bet. And maybe they don't go all the way to zero. Maybe they get so cheap that another company buys them, and the stock goes away, and it just becomes part of another company or something like that. But a lot of these stocks are dead. A lot of just totally dead money. So I don't know. I'm looking at it. I don't know how accurate that actually was. It said Netflix didn't make any sense to me. How could you be down 76% and only need to go up 131% to get to high? I'm not sure I understand that. Oh, I see. It's already up off the low 83%. I see. So it's still got another 131% to get back. I got it. And Coinbase, for that matter, is already up 80%. Yeah, it's already up 80% from its low and still needs to go up another 406% to get to its high. That makes more sense. I was like, that math doesn't make sense to me,
Mm-hmm.
but now it does. So it's, yeah, it was down almost 90, so it needed almost 500% to get back to even at one point. So these are already up a lot off of their lows, and I think it's more likely that they go back to their lows than to their highs.
Yep. Something else. So they definitely have a ways to go. This one, so credit cards, again, what I was just talking about earlier, having that amount of debt out there right now and on credit cards. This right here, so it's average credit card interest rate for those that are paying interest, so have not paid out their card. Shane, this doesn't look good.
Nope. That's why they're not saving. I mean, you got if you got to pay the finance fee on your outstanding balance on your credit card at 18.43%, doesn't leave a lot of money left over to save for retirement. So, yeah, that's just I can't believe how high that it's higher than it's ever been going back to 1995 when they started keeping track of this. So,
Hmm.
it's not good.
Yep. And then Shane, this next one, this is good. So here's XLK. This is the ETF for tech. And then here's SPY. So S&P 500 this is the ETF as well. And just looking at the weightings, you highlight this, but we just went through those charts. Apple, Microsoft, some of them, the weighting, I mean, XLK makes up about 40%, S&P about 12%. So, how do you interpret this when you're looking at the market?
I just think it's funny that people think they're buying a diversified fund, right? So you put your money in XLK, it's an ETF, it's diversified. No, it's not. It's 45% in two stocks. If you came to me and I told you I was going to put 45% of your money in two different stocks, I hope you would tell me no, right? Look, that's just crazy. It's not diversified at all. That's bananas. The SPY isn't even hardly diversified anymore, with Apple being 7%. I mean, this market is mostly Apple at this point.
Hmm.
Apple is 14% of the NASDAQ now. So whatever Apple does, if Apple goes up on the day, NASDAQ probably going to go up on the day and vice versa. And I don't know. It's just, if so far Apple has held up better than a lot of other stocks, but if that thing crashes like Facebook did, look out. The whole market can go 50% lower from here
Yep.
and before you can even blink. So yeah, scary stuff.
And then FactSet earnings growth rate. And I'll point this out, just a little education here. So the SPY is market cap weighted. So that means the most successful companies or the largest companies kind of work their way to the top. And right here, ExxonMobil, 1.4%. That's kind of been moving up the list. But
You can see the energy sector too on there if you go back one. Energy sector on the left-hand side
yep,
of that right picture is energy is only 5% of the S&P 500. Yet, yeah, yet look at the next chart.
yep. So then the next one here. So, growth X energy and with energy. So, with energy, we're up 2.2%. It's certainly not a positive number if you take that out. So energy right now is just kind of kicking butt and carrying a lot of weight.
It's the only place where you can see profits in the whole S&P 500 pretty much. And so without energy, um, profitability across the entire market would be lower both over the quarter and for the calendar year. So we're basically in an earnings recession already, and there's no two ways about it.
Nope.
Um, Eventually that will carry through to the broader economy.
And then so this is a big one. This is I think the best predictor we have, right, Shane?
Yeah, this is it. I would put all my money on this one.
Yep. So according to Not the Bee, every time the Phillies win the World Series, we have a financial crisis. So, I'm no sportscaster, but I'll do my best. Right now, we're 4 games in. It's 2-2. Tonight, it's a home game at the Phillies, and I'd love to root for them. But if I want to look out for my investment portfolio, hopefully they slip on a banana peel. I don't know, but we don't want them to win, I guess.
We're all Astros fans, I think. So tonight, or no, sorry, but Sunday, Game 6, right? Yeah, game 6 is what we're on. So
Well, no,
Saturday.
game 5. So today, 8
Oh,
p.m.
there we
and
go.
I don't know, probably that's Eastern, I bet.
Yeah, tonight at 8. Yep, 8
And
Eastern. You
then
got it.
Saturday, and then this is the big one. So you're going to want to sit here with your investment portfolio teed up. Game 7 is
If
on, what is it, Sunday, November 6th, assuming they get there. They might
Yeah,
end
if
it
they make
before
it
then.
there. Yeah, could end on game 6 at this point. Won't
Yep.
won't be over tonight though.
And then this one, anyone looking for a job, if you want to look at the qualifications for a Fed chair, here you go.
Yeah, this is a great one from the B. We don't have time to go through all of them, but there are a couple of good ones. I think number 9 was good. Must be proficient in double speak, always leaving ambiguity in your words. And number 10, experience with blame shifting. 11 was good too. Must be able to call 100th of a %, 1 basis point in order to sound smarter. Very funny, man.
And
Babylon Bee is great. If you guys don't get their daily email, I would highly encourage you to subscribe to their daily email because it's always just a good laugh no matter how your day is going. It's good to have that little break. So
you bet. So
yeah, check it out.
until next week, Shane, you did take the bear off. You're not wearing the bear anymore, but
Right on an hour. Right. Oh,
yep.
you can't see it. Right on an hour. So sorry for
Or,
taking up so much of your time. Hopefully you guys thought it was worth it and got something out of it.
yep. So until next week, Shane, thanks again. I'll see you then.
Thanks, Kyle. See you, buddy.
Yep. Bye.